what are some first-time, what are some things first-time car buyers should know, and what kind of things should they bring with them when they're buying a car?
All right, the biggest thing, the first thing is know what your budget is. A lot of people will come into the dealership and say, I want to be around $400 a month, but yet we're looking at a $70,000 truck. Mathematics is what we're here for. It doesn't compute. There's no way to get to that number. So that's the biggest thing, is know what your budget is. When you go into a dealership, let them know what your budget is. We're not going to steer you wrong. We're going to try to steer you to something that is within that budget there. The biggest thing when you come to a dealership, what you need, and the state requirement, is identification. You got to have a passport, driver's license, state issue ID, and it does have to be valid to do that there. If you currently have a car and you're getting ready to get another car, you're going to need a copy of your valid Florida State insurance as well. And then if you're transferring a tag, you're going to need a copy of your registration is what you need.
So when you said that that they should know what their budget is, so you mean like their monthly budget, like
Correct.
what they can afford on a car payment and a monthly?
Correct.
Okay, great. Let's see. Okay, next question is, I remember this one comes from DJ. Shout out DJ. She said, what should I look for in my financing agreement to make sure I'm getting a good deal?
The biggest thing, and honestly, the only thing really, is what your interest rate is. Sometimes you want to make sure, and it doesn't hurt, a lot of people do it when they come in my office, is shop around just to see what the average rate is going, especially, there's all different types of credit. You basically have tier A, which is the best, and you have tier D, which is the worst. Or I wouldn't say the worst, it's just not the best for sure. And all that based upon your interest rate. Obviously, the better credit rating that you have, the better rate you're going to get. So therefore, you could spend more money and your payment be a little bit lower versus buying a car and then your interest rate's much higher. So therefore, the payment will be much higher as well.
So yeah, that leads us into another question. Someone was asking about like how does a down payment and an interest rate go into like your monthly payment kind of thing? How do these affect each other?
Down payment on the average, and a rule of thumb we always use, is basically for every $1,000 that you put down, it's going to make about $20 difference in your payment. So if you're putting $5,000 down, it's going to make $100 difference in your payment. Term also makes a difference. Obviously, depending on how long you want to finance a vehicle for. Obviously, the shorter you go, the higher the payment is because you're paying it back in less time there as well.
So, will you say that again? For every $1,000 you put down?
On a rule of thumb, and you obviously notice if you ever see car advertisements when they're advertising either 0% or 5.9%, you'll always see at the bottom of the television screen, and if you're ever watching it, at the bottom of the TV screen, it will always say what per $1,000 what your payment will be. So I know like 0%, if it is available on a particular car, it's $16.67 per $1,000 that you finance. So we always just rule of thumb because a lot of times 0% is available, but a lot of times it's not. So it really depends on the term that you go, but a rule of thumb we use is $20 per $1,000.
So what about a good down payment? What do you think is a good down payment they should be saving for?
Typically, and since none of y'all ever bought a car before, we'll use you as first-time buyers, and we do Mid-Florida here in town, very good bank. They do have a pretty good first-time buyer program.
Not a bank, it's a credit union.
As long as you've been a member with them, you have to, a couple requirements are you have to be on the job for 6 months. They will not allow you to have a payment more than 18% of your monthly income. So if you're making $2,000 a month, the highest payment you can have is $360. You can't buy a vehicle over 75,000 miles, and they will only let you finance 80% of the value of the vehicle. So in that particular case, you would need at least 20% down on that particular car, as long as you fit within those guidelines.
20%.
Is a good rule of thumb.
Okay. Some of these are kind of opinionated questions. So, like, what do you think is a better investment deal, a new car or a used car?
There's a couple of different ways you can look at this. A lot of times when people are looking at a much older car, sometimes they are more expensive when it comes to payment versus buying something new. Reason being, when you buy an older vehicle, interest rates are typically a little bit higher because it is an older vehicle. They won't go as long as in term as far as payments for you. So therefore, the lowest interest rate you'll ever get is on a new car, because that's point blank. So if you're buying a used car, and say it's the same price as a new car, the new car is going to be cheaper just for the fact interest rate's going to be lower, you can go different terms, so therefore that equates it that way. There again, sometimes if you can find a nice used car that is not that old and has some lower miles, sometimes that's what you might want to look at. Like we have several 24s on the dealership that have less than 5,000 miles on it, but the price offset compared to new, you're better off just go ahead with a used vehicle. So it's honestly a case-by-case basis, but you just kind of have to look at the overall picture of it.
This is my question. I was curious. So why are interest rates lower on new cars? I didn't know that.
It's less risk for the bank because the banks, one, know that the vehicle's under warranty. So if you're struggling with a payment and something happens to the vehicle mechanically wise, they know the vehicle's going to be fixed. Historically, just what studies have shown as far as economics is that if you buy a vehicle that's a used vehicle and you just are able to afford the payment and the car's out of warranty and something happens to break on it, especially say if it's $1,000, $1,500 repair, it's going to be very hard to make your car payment and then fix the vehicle on top of that. So therefore, a lot of times that's when you kind of get in trouble with the bank, because I can't make the payment because I'm trying to fix the car, and then that gets in a totally different situation there. So a new car is less risk for the bank.
So let's see, we have some personal questions. So like, what do you like about working in finance or about helping people buy cars?
The biggest thing is just exactly what you said. It's just helping people. I do enjoy helping people. Sometimes when a young person like yourself comes in and you're trying to look for something, and I was able to help you, especially if you've gone to a couple other places and they weren't able to help you, and I was the one that was able to help you, it is a little rewarding on that part as well.
Questions? Do you guys have any more questions? You look like you were going to ask your question.
Go ahead.
This isn't particular pertaining to cars, but like in terms of like building your credit in order to, so you can get a loan for a car, like how long does that generally take, and what's the best way to do that?
Okay, and another thing, good question, and there again, it's always when you have someone come into the dealership, and it's just like a baby. You can't just come into the dealership and say, I want this $50,000 truck. You might be able to say, the bank says you might only qualify for $20,000. It's just like a baby I was referring to. You got to kind of crawl before you can walk. That's the same way with credit. The biggest thing is if your mom or dad is able to help you get like a credit card of their own, but put you on it, because you can't have credit until you're 18 years old. You can't legally buy a car in financing until you're 18 years old. You can go in a dealership at 17-year-old if you're paying cash for it, then there's no requirement. As long as you have a valid driver's license and insurance, you can buy a vehicle there. But as far as if you had like a credit card or something to kind of help you get some type of credit, some type of payment history, even if when you turn 18, and even if you get like a $200 or a $500 prepaid credit card where you give them the money and then as long as it reports on your credit bureau, and and I tell people all the time, even if you're putting $20, $25, a tank of gas on it once a month, pay it off, because they can't charge you any interest as long as you charge it and pay it off within a 30-day period. So that way it can easily start to show some type of history, and it makes it much easier come time to buy a car. Or actually when it comes time to finance anything, really.
That made me think of, are there any mistakes you see when people are coming in trying to buy a car, trying to get something they can't afford?
Yeah, and the banks have we're not inventing the wheel here. I mean, car buying is way longer than all of us. So, and then bank financing too has done the same thing. they can kind of look at a situation and know that this is not the car for you, so they're probably not going to help you out when it comes to that. But there are other cases where you kind of have to rework the deal and look at it there. But it's just.
Be my camera girl.
What was the question?
Common mistakes you see.
It's just basically sometimes biting off more than you can chew. So if someone comes in there and you know your budget is $400, but yet you really, really want this truck and it's $600 a month, then all of a sudden now you start, if you're slow on your payments, then that will definitely affect you. Because keep in mind, when you get something financed, it's going to be on your credit for 10 years. So there's no savings like, oh, I made a mistake when I was younger. Even if you're 18, come 27, it's still going to be on there, and it will affect you because there's other things in life that you're going to need to finance at that point, unless you have the cash to pay for it, is cars, houses, and then credit cards. And the biggest thing. And then some credit cards, you don't want to make a mistake of getting credit cards and just maxing them out and just making the minimum payment. Because literally, and you guys can go on a calculator, like a credit card calculator, and it's astronomical what you will pay the bank back versus paying it off, because it takes years and years and years to get that handled. So the biggest thing, and I practiced that myself, my grandfather instilled it into me when I was younger, is whatever you put on the credit card this month, make sure you have enough to pay it off at the end of the month, because it's okay to borrow their money, and but as long as you're paying it off, that way you're not paying any interest on that there as well. And I will give you a tidbit of information that I've learned myself, and especially because we don't hardly use cash anymore. You've got debit cards and you have credit cards. Even though it says Visa on it or MasterCard on it, they look the same, but they are different in terms of, and I see this all the time, of this fraud. Because if you use a debit card and it's a fraudulent transaction on your account, what happens on a debit card, if you had $1,000 that was charged on it, the bank will hold that money until they can deem that that was a fraud account, and then they will release that money back into your account. A credit card, so if you have, say, a $5,000 limit, and that $1,000 is a fraudulent on a credit card, that still doesn't take any money out of your pocket. They will hold that on the credit card, and then once it is declared fraud, then they will release it at that point. So you don't, with a debit card, it's holding your money up. With a credit card, it's not doing anything until they finalize the transaction there.
Megan, do you want to say something?
Yeah, so the last car that you sold, how much was the car?
I'm trying to think.
We're gonna input some numbers just so that kids can see what an amortization chart looks like. So when we talk about interest,
Right.
they'll see how much goes towards interest versus how much.
What the total overall finance was?
Yeah, how much was the car?
I'm trying to think what I did for them yesterday, so.
That's four cars.
Yeah.
Give us the nicest one.
We did a F450 for a company that bought one, and it was right around, I want to say $88,000.
My lord.
Yeah.
All right. And interest rate for that, I'm guessing since it was.
That particular one was in a business.
Right.
So business rates are a little bit higher than a personal interest rate, because there again, it's a little bit more risk for the bank, because if the business defaults on a loan, there's not really much they can go back on an individual and affect your credit, because it's attached to a business. So I believe the interest rate on that one was 8.74%.
Not bad. Not bad. And do you know the
And that was 60 months.
60 months. Cool.
Yeah.
So hey, with bigger trucks, they usually finance it past.
In businesses, the banks prefer to go 60 months, which is 5 years. In some particular cases, they will do, they will do 72, but majority of the time, the banks prefer to go only 5 years on a business.
Given depreciation. So guys, y'all look at this monthly payment, right? The monthly payment is about $1,800, all right? And again, this is for a business, this is business financing. I'm pretty sure the company knows that they're able to maintain this given what type of business is going. So So I wanted to do this so that we can look at an amortization scale, and y'all can see how interest affects your situation. Where did she go? Monthly number of payments, 60, counting rate. Here's your amortization scale. So right here, as you can see, the monthly payments are exactly the same every single month. But look at the principal that goes towards that payment versus the interest, okay? So there's a lot of interest being paid in the beginning, a lot of interest being paid, but as we go year after year, even all the way down to the very last payment, there's only $13 in interest. More of this principal is being paid off. Principal is the actual 88,000 towards the truck.
Correct.
So again, guys, we had a great question from Mr. Arias right here, Mr. Running. Credit, building your credit so that you can get a favorable interest rate is somewhat ideal. Okay, very ideal, more ideal than a down payment. And again, once you start getting to these manageable monthly payments, again, don't buy the $88,000 car. Okay? When you get a manageable payment, maybe it's in your best interest that you start attacking more principal so that you can kind of lessen that interest quickly. All right, and again, that's why they do the 6 months financing. They want to keep you on that scale simply because the interest, it's got to be paid. When that truck left the lot, it was paid for when it left, right?
The bank pays for
Yeah,
it.
the bank paid. So remember, as soon as that vehicle leaves the lot, it is already paid for. All right, they got their 88 that day. So now you're just paying that loan back to whoever sent that 88, and they want a little bit of extra. So as a way of kind of not really winning, but defeating the entire process, try to put a little bit towards the principal over time so that you can cheat the interest. All right. If not, they gonna look how much that $88,000 car costs. Y'all see that? That $88,000 car actually costs $109,000. See that?
Correct.
That's how much is gonna be paid over the course of.
We did that without buying a car.
Right.
Project we just did, guys, when it was like your monthly payment times 6 months, and then you could see how much you actually paid for that $88,000 car. But yeah, you said something about banks, and you told me about it earlier. What are some banks that you guys deal with? You said Citizens, Mid-Florida.
Some dealerships will have a galore of banks, but we try to keep it kind of small because if you do a lot of business with particular banks, if you have a deal that gives you a little bit of a hiccup, you got somebody to fall back on that will help you out or take the risk on it to kind of help you out there. So Ford Motor Credit, obviously we're a Ford dealership, so that is our biggest one. We have Ally Bank, we have Citizens Bank and Trust, that's a local bank here in Mid-Florida like I was talking about. Suncoast, and then we have Santander.
Did you take the video over
credit
me?
challenge deals that we do have.
You kept it on here?
You have Exeter and Westlake, but there's a
I
big
appreciate
group, more of it there. But I wanted to say something about this graph here. If you will just kind of pull it up a little bit, and I'll kind of give you a quick explanation of what I tell a lot of customers when they're in my office, especially first-time buyers. Now, the state of Florida, you can stop it right there.
All right.
The state of Florida is very, very consumer protective when it comes to vehicles. Some states don't have certain requirements, like if you come in my office and you want an extended warranty on a vehicle, as long as it's the same vehicle, if you come in there and want a 5-year, 100,000-mile policy on it, you're going to pay the exact same thing that I'm going to pay for it, as you would pay for it, or anybody else, as long as it's the same vehicle. I know, like the state of Georgia, you can be charged $1,000 more than what I potentially, or $1,000 less. So there are variations on that there. The state of Florida, when it comes to insurance, it's mandated. Price is a price, you can't help it. The way this loan is set up right here, this is a simple interest note. And that's the only way Florida will do interest or loans, because it's there again, a protection for you.
I was gonna put Cal
So if you
Watson.
finance that 80, the money there, if you just make one payment, at the end of the term,
Cal
that's
Watson.
all the interest rate you paid was the $640. And that's the way simple interest works. But if you decide I want to make a $2,000 payment, anything above that $1,850 will go directly towards the principal of that balance. And then it definitely affects the interest rate, because therefore you overpaid them. So the bank the next month wants you to make a lower payment because you've overpaid, there again, you make that $2,000 and you could substantially save yourself tons of money when it comes at the end of the term, especially when it's on a big balance like that.
Right.
Because like in the mortgage industry, if you did a 30-year note on a mortgage and you just make one extra payment a year, and granted that's a 30-year mortgage, but it takes 7 years of loan payments off that amount. And that's a good rule of thumb. Some other states will use what's called Rule of 78, which is a no-no in Florida. What that basically says is if I want to finance that $88,000 and I want to pay it off in 3 months, that $20,000 interest rate or interest total accrued interest, you're going to have to pay that off right then and there, because the bank's going to get their money one way or another, whether you finance it for 1 month or you finance it for 60 months. But there again, the state of Florida, as a protection for us as consumer, that's the way we do business here.
Everybody help me thank Mr. Aycock for coming. And you guys can go ahead and pack up and go to class.
All right.
Thank you very much.